All right, imagine this. We are standing on the deck of a gigantic cruise ship at midnight. This ship has been at sea for 85 years, and it is not an ordinary ship. It is the most successful ship in history. Its name is Dollar. Everything appears completely normal. The lights are still on. The music is still playing. The ocean at first glance looks calm, but if you stand still for a moment, you will feel a very slight vibration beneath your feet. Not a collision, not massive waves, just a very subtle tremor. And the central question of today's conversation is this: what happens if the real problem is not a typical economic recession, but that the ship itself is drifting off course? So, what is our objective today? We are going to examine where these tremors are coming from, how the passengers, that is, other nations, are reacting, and ultimately what it means for each of us as individuals. First, we will return to the ship's original blueprint, the crucial decisions of the captain that altered its route, the historical turning points. Then, we will observe what the other passengers are doing as they begin to sense these vibrations. Next, we will go down into the engine room to see whether something is happening internally, whether there is any structural issue, and finally, most importantly, what all of this means for the future of the voyage. Let's begin. Let's go back to the starting point. After World War II, the world boarded the ship Dollar. The agreement at that time sounded very simple and very attractive. Countries would price oil trade goods and hold reserves in dollars. In return, the United States would provide stability, a strong currency, and protection for global trade routes. At the beginning, this ship had something extremely solid to keep it stable: a gold anchor. Exactly. That was the Bretton Woods system. Each dollar at that time was backed by a specific amount of gold. But then came a decisive moment, a turning point, that changed the entire story. The year 1971. President Nixon. When he declared the end of the dollar's convertibility into gold. In essence, he ordered the anchor to be lifted, meaning the removal of the ship's gold anchor. From that moment on, the ship no longer relied on a tangible physical asset. It began to rely on something far more intangible: trust. The system shifted from a gold-based foundation to one built entirely on a promise, the promise that America would always be able to repay its debts. And trust, no matter how powerful, is still a form of psychological fuel. It can be eroded if overused. And in reality, it has been tested. When I revisited the documents, I found that there were two major tremors in recent times that truly tested the limits of that trust. The first was the pandemic in 2020. The U.S. Federal Reserve, the Fed, printed $4 trillion in just 8 weeks. $4 trillion. It is truly difficult to comprehend that figure, an almost unimaginable number. It felt as if they were trying to extinguish a small fire with an entire ocean of money. And that comparison would not be inaccurate. That was no longer conventional monetary policy, but an emergency intervention measure. Then came the second tremor, this time carrying deeper geopolitical significance. The year 2022. After Russia invaded Ukraine, the United States and its allies removed Russia from the SWIFT system, the global messaging network for banking transactions. When reading about this, try placing yourself in the position of another passenger on the ship. The first reaction would likely be panic, because if the captain can lock a passenger inside their cabin and deactivate their key card, then could you be next? That was precisely the message other nations received. And it did not remain a vague fear. It turned into a very concrete risk calculation. What does that mean? It means that dependence on the dollar is no longer simply an advantage, but has begun to become a strategic vulnerability. What is interesting is this. When you begin to weaponize the very infrastructure of the ship, you inadvertently teach the other passengers how to build their own lifeboats. And that is exactly what began to happen immediately afterward. The other passengers are no longer sitting still, they are finding their own exits. China and Brazil began trading oil in yuan. India purchased Russian oil in rupees. Even the Gulf states, including long-standing allies of the United States, have publicly discussed pricing oil in multiple currencies. This is no longer theory, it is happening in reality. And central banks are acting very decisively. There is one figure in the reports that truly struck me. 2024 marked the third consecutive year that central banks around the world purchased more than 1,000 tons of gold annually. This represents a major reversal in trend. In a digital world like today, why would they return to such an ancient metal? There are three main reasons. First, gold is a hard asset. Second, it carries no counterparty risk. Its value does not depend on the promise of any government. No one can devalue it. And third, most importantly, no one can print more gold. A survey by the World Gold Council in 2025 showed that nearly 95% of the central banks surveyed expect to increase or maintain their gold holdings. Gold is returning to its role as a financial anchor in times of instability. But they are not only accumulating gold, they are also building their own pathways. In fact, that is the more important part. They are not just buying gold. They are constructing a parallel financial infrastructure, a parallel system. China's CIPS payment system, considered a rival to SWIFT, is growing at a very rapid pace, with its transaction volume increasing by nearly half just last year, very quickly. The BRICS bloc is also discussing the implementation of its own payment system called BRICS Pay. They are building a safety net, a financial pipeline system entirely outside the control of the dollar ship. So the passengers are preparing contingency plans. But that raises another question for me. What about the ship itself? Is something happening right inside the engine room? This is an extremely important question, and the answer is yes. The first issue, and the largest, is public debt. The current figure is $36 trillion, equivalent to approximately 120% of GDP. The documents used a very sharp metaphor. The ship is not only burning fuel, it is borrowing fuel to pay interest on old fuel. $36 trillion. How can a nation sustain such a massive debt? What is different compared to the past? The difference is enormous. After World War II, the United States was the largest creditor in the world, with a young population a manufacturing powerhouse. And now the complete opposite. The United States is the largest debtor. The population is aging. Manufacturing capacity has weakened. At present, the cost of servicing that debt is consuming nearly 20% of the government's tax revenue. This creates a mathematical trap, something that resembles a dilemma. Exactly. On one side is the risk of market collapse, on the other is runaway inflation. The first option is to allow interest rates to rise high in order to attract investors to buy government bonds, but that is extremely dangerous. It could collapse the stock market and real estate markets that have become accustomed to an era of cheap money lasting more than a decade. The second option is to continue printing money, to purchase government bonds, a process known as debt monetization. And that will certainly generate higher inflation, eroding the purchasing power of the dollar itself. The metaphor in the documents is highly ironic, the crew buying tickets to their own ship to maintain the illusion that the ship is still full of very powerful image. And meanwhile, there is another issue spreading across the ship's social inequality. The wealth gap is currently at a record high. A recent report shows that the top 1% of the wealthiest individuals in the United States hold approximately 32 to 35% of total wealth, while the bottom 50% of the population hold only about 2 to 2.5%. An enormous disparity. The image is very clear: rows of luxury suites on the upper deck and cramped, overcrowded cabins below. That is certainly not healthy for the collective morale of a long voyage. This polarization weakens the social foundation. As instability increases, trust in the leadership in the captain will erode. And as we have said since 1971, trust has been the only fuel keeping this ship operational. A global reserve currency requires a truly strong real economy and a stable society to back it. But cracks are appearing from within. So, what does all of this, the loss of confidence from the outside and the tensions from the inside, mean for our course? There is a very important point emphasized in the documents. This is not a Titanic-style shipwreck. We are not talking about a sudden collision. The shift will not happen overnight. It will resemble a slow process of erosion. It will not feel like an abrupt crisis. It will feel like your grocery bill rising 5% each year instead of 2%. The nominal returns from your retirement fund still appearing large while real purchasing power declines. The ship does not hit an iceberg. It simply gradually loses efficiency, the engines growing weaker over time. And this is where the real risk emerges. The greatest risk is not a recession, but a change in the rules of the financial game. What does that mean? This is the core point. Consider a very specific example, the retirement plan of a highly disciplined saver. They calculate that upon retirement, they will have $1,800,000, a fairly large figure. And that number is based on old assumptions, average inflation of 2.5%, per year investment returns of 7% per year. But what happens if over the next 25 years, average inflation is not 2.5%, but 5%? Wait, that means even if their account statement still shows $1,800,000, that amount would only purchase goods equivalent to about $800,000. Today, perhaps even less. That is a devastating loss of purchasing power. The yardstick of value has changed. And the irony is that those who are hurt the most are not the reckless, but the disciplined savers who believed the rules would never change. They played by the rules, but the rules of the game were quietly rewritten. They believed that government bonds were absolutely safe assets, believed that the dollar would always hold its value. But if structural inflation is higher than real interest rates, that is, nominal rates minus inflation, will be negative, and their purchasing power will be silently eroded. So what can the captain do? What are the options for the United States? Can they turn the ship around? Economists propose several scenarios, and none of them are easy. The first option is genuine repair cut, spending, raise taxes, reduce the deficit, but this causes short-term pain and is clearly unpopular with voters. The second option is to change the fuel system, for example, returning to some form of gold standard. But the mathematics are difficult. Public debt is $36 trillion, while U.S. gold reserves at market value are only about $600 billion, a ratio that is not easy to balance. And there is a third option, a relatively new idea, a breakthrough idea, establishing a strategic Bitcoin reserve, using a decentralized digital asset as a new kind of anchor. That is a very bold idea, based on the possibility that the United States could seize Bitcoin from legal cases, from mining activities, or even tax it in Bitcoin. The idea here is to build a national reserve, a leverage tool for a world in which trust in government debt is gradually declining. However, regardless of the option chosen, restructuring the system will be extremely complex. So, for an ordinary person listening to this video, perhaps feeling somewhat anxious about these tremors, what should you do? Hide under the bed? No. This is not a story about fear, but a story about awareness. Economists generally propose a common strategy. First is diversification. Think beyond purely dollar-denominated assets. Consider real assets, such as commodities, gold, and perhaps a small allocation to Bitcoin as a form of insurance against currency debasement. Second is caution with long-term bonds. Extreme caution, because if inflation and interest rates remain structurally high over the long term, then long-term bonds will suffer heavily. That is mathematical law. And finally, perhaps most importantly, invest in your self-skills, productive capacity businesses that generate real value, because those are things whose value is not entirely defined by a unit of currency. If the measuring stick changes, your ability to create value remains. That is the type of asset that cannot be eroded by inflation. So, to summarize, the dollar ship will not sink tomorrow. The music is still playing, the lights are still on, but the tremors beneath our feet are real, and they are growing stronger. Recognizing the vibration early is always better than pretending it does not exist. We are living in a system that is transitioning. Therefore, I want to leave one final question for all of us to reflect on. The real question is not whether the measuring stick of value will change, but what the new measuring stick will be. Will it be a basket of currencies? Will gold return to a central position? Will it be a digital asset like Bitcoin, or something we have not even imagined yet? A race has begun the race to shape the world's next unit of account, and it is unfolding quietly.